Invest a lump sum or bit by bit? Which is smarter? So we're going to talk today about, let's say you have a lump sum of cash from somewhere and you're trying to think about whether you should invest it. Market's pretty turbulent at the moment. Should you put it in all at once or should you spread it out? You might get it, you might get a bonus, for example, or you may be just doing your annual RSP contribution in one shot. We actually get quite a bit of it from either from new clients that have cash to invest, or we do a fair amount of the Smith Manoeuvre strategy, like various leveraging strategies. And then all of a sudden you're borrowing, 2, 3, 4, 500, 100,000 or a million in one shot. So should you put it in all at once or spread it out? So I'm coming to you live today from a cruise ship in the Caribbean. This is a fun thing for me to do on vacation, is sit by the pool and read some financial books and then come up with a topic and record a video. So this is a fun thing for me. So what you're going to learn today is lump sum investing or bit by bit, which is smarter. If you choose dollar cost averaging, that's the bit by bit method. Which time period is best? Should you do it over 3 months, 6 months, a year, 2 years, 3 years? Like, what's the smartest thing? So we're going to look at this topic from various directions. So what does conventional wisdom say? What do studies say? What's the smartest for growth-focused investors? Like, a lot of our clients are growth-focused. And also, what's smartest for people that have a financial plan? And then I'm going to end with my advice, my insight into this whole topic. So first of all, let's talk about dollar cost averaging. So dollar cost averaging is the industry jargon for investing bit by bit. Okay, and there is a bit of beauty to it, actually. So if you just, let's say you invest $1,000 a month every month, what your advisor may tell you is you are guaranteed to outperform your investment. Okay, now that's not quite technically true. What happens is you're guaranteed to outperform the investment that you have for the amounts that you have invested. Like, one amount's invested for 12 months, one month's for 11, one for 10, that kind of thing. So, but it's actually kind of a cool thing. So if you have an investment that you invest every month and the investment makes, 10%, you are guaranteed to outperform it. And it's kind of funny because, for people who say, again, nobody can beat the index, a very simple way to beat an index is to do dollar cost averaging, and you're guaranteed to outperform whatever investment you're buying. And the reason is because you're putting an automatic amount in whenever so your investment will go up and down with time. And so when it's down, you're buying more units. When it's up, you're buying fewer units. So at the end of the year, if the investment went up and down like this, you actually bought more units lower. You have more units than if it had been a perfectly smooth investment that had not fluctuated. So the more your investment fluctuates, the more this dollar cost averaging works for you. So this is there is some beauty to this whole dollar cost averaging strategy. So now let's talk about the risk. So dollar cost averaging, what it does for you, it protects you on the downside. Gives you some downside protection. And this is actually the main reason why I think people don't want to invest. You've got 100,000 or 500,000 to invest all in one shot. If you put it all in, it's growing as of today. But what happens is you put it in. What happens if the market crashes, the next day or shortly after it crashes, and you've just put money in and it's crashed, and it's taken a big 20 or 30% drop. Now that is quite unlikely, but it's possible. So that is a risk of putting in a lump sum in one shot. Okay, so now dollar cost averaging protects you to some extent. Okay, so I have 100,000 to put in. Instead of, if I put it in all once, it could plunge. But let's say I put in 1/12 of it a month for 12 months. Okay, so now if it falls in between, what happens is I've invested some, but other amounts I haven't invested, and I invest it while it's lower. So that could be a plus. Now, it doesn't completely protect you because you could still put 12 monthly amounts in, and then as soon as the last amount goes in, it plunges. So it's nowhere close to good, perfect protection, but it does give you some downside protection. So now what you risk from it is missing the growth, the other side, because there's always another side to every topic. So, you put the money in and it takes off right away. So, and you put the money in, that's awesome. Now, if you're investing bit by bit, you're missing that, right? So you just put 1/12 in, the market takes off and you've 11 months to go and you've missed the growth. Okay, so there is downside risk, but you have a risk of missing the upside. So so that's the dollar cost averaging, kind of the pros and cons of it. So now also there's another question is, if you're gonna invest bit by bit, should you do it, how do you do it? Monthly? You put in a third now, a third next month, or 3 months, or 6 months, or 12 months from now, and then a third, a quarter, like so. There's a problem with dollar cost averaging, and it's trying to figure out which one it is. And one advice that I have is, if you decide on dollar cost averaging, decide on what you're going to do and just do it, and just stick with it. Like, the worst thing you could do is, I'm going to put in a third now, and then I'm going to wait until my gut tells me I should put the next third in. Because I'll tell you, the human gut is a disaster for investing. So now I've talked to quite a few investors who say, my gut, how do I know if my gut is, telling me something smart to do? And I could tell you a foolproof method. So here's the method. If your method is a human gut, then it's horrible for investing. Okay, so all professional investors have a method to deal with their emotions, because your emotions always going to tell you when it's going down, oh my God, panic and sell, and when it's going up, I'll pile money in. And really, you should be doing the opposite much of the time. So the worst thing you can do with dollar cost averaging is try to go by your gut. So if you decide you're going to do a third now, and a third in 6 months, and a third in a year, then stick with it and just do it. Now, I would give you the one exception to that is, there's always a big buying opportunity when investments are down, especially if they're down 20% or more. So my general advice here would be is, if you decided, let's say you're going to do a quarter a month, or you're going to do a third now, a third in 6 months, a third in a year. 6 months from now, the market is down 20%. I would suggest stick the whole amount in, because you just got this big sale and it worked for you. If you wait till the end of the year, who knows if it's recovered yet. All market declines based on history recover, and usually fairly quickly, within a year or two. So if you wait, you may well miss it. Okay, so that's the dollar cost averaging. Of course, the lump sum, the big thing about the lump sum is, whatever growth happens, you get it right away. If it goes down, you lose it right away. So now, what does the conventional wisdom say? Now, the conventional wisdom, the general investment industry are usually all about risk tolerance, and to me, I call it short-term, temporary decline risk tolerance. And so they will tell you dollar cost averaging is a pretty smart thing. Now, most advisors still prefer you put money in right away, because most of them are actually, commission based or something when you're putting money right away. However, they'll tell you this dollar cost averaging helps you because you may not have the risk tolerance to put it in all at once. So that is kind of the conventional wisdom approach. Now let's take a look at studies. So there's a study by Richard Williams and Peter Bacon of Wright State University. There's actually lots of these out there. These guys are from Ohio, and so they took a 7-year study. And what they looked at was either putting in 120,000 on January 1st, or putting in 10,000 a month at the first of each month for a year. And they looked back through 70 years of history to see what worked. And 67% of the time, the lump sum outperformed. So 2/3 of the time, lump sums ahead. So now I've done my own study, and basically, and I looked at it spreading it over 3 years. Let's say you put in, you put the full amount in today, or you put a third now, a third next year, a third year after that. Okay, so that's in that case, it turns out about 80% of the time, it's worthwhile. The lump sum outperformed. Okay, so the studies kind of consistently tell you that most of the time the lump sum outperforms, and you're probably going to make more money by putting it in all at once. Okay, now that is completely logical, and I'll tell you why. It's because the market goes up most of the time, so that's what you'd expect. So if you look at how often does the stock market go up, it goes up 63% of months, but 75% of 1 year periods is rolling 12-month periods, 83% of 2 year periods, and 86% of 3 year periods. So what you find is the success of the lump sum is usually, fairly close to these numbers. Most of the time the market goes up, so therefore most of the time lump sum will give you most of the money most of the time. Okay. Now, so we talked a bit about risk. Let's just talk about growth. So growth-focused investors, so most of our clients who tend to be very growth-focused people, and partly is because I think that's the kind of people that we can make the biggest difference in their life. And also we help our clients to learn to have the higher risk tolerance. Risk tolerance is a learned skill. And if you do that, you can focus on growth and you can become much more successful financially. And we help our clients, to come to that, become growth-focused investors to the extent that they can do it. So growth-focused investors usually prefer a lump sum. Okay, so it's more likely to give you more. So the longer you delay, the lump sum is going to likely work, and the longer you would otherwise delay it for, the higher chance that the lump sum is going to work. So growth-focused investors, you're trying to think of, how do I get the most money long term, and most likely the lump sum is going to do that. So now, if you are a growth-focused investors and you're just somehow uncomfortable putting the whole amount in today, in general, the advice then is the shorter the time period. You can do over 3 months, 6 months, a year, 2 years, 3 years. The shorter the time period, the better, because the shorter the time period, the more likely you're going to get more money out of it. It's going to grow more for you. Okay, so spreading out contributions, the whole dollar cost averaging, it's actually not about making more money. Okay, if you're going to spread it out, you should do it assuming that you're probably making less money. Okay, but to do it, it's all about risk reduction. Maybe you may not, it might be just emotional risk, or it might be, your gut telling you that, or it might be just that you don't have you're scared of what happens if I put a large amount in. Like, we do have clients putting, 500,000 or $1 million in one shot, and I get why that's uncomfortable for a lot of people, especially if it's the first time you've done it. Personally, I would have no issue. Like, the bigger amount put in, I'd stick it in right away, because I'm always just thinking about, how do we get the growth, and the quicker you put it in, the quicker you can get the growth. So, but yeah, so spreading it out is all about risk reduction. It's not about, what's the odds that you make more money? You're probably going to make less. Okay. So yeah. So now the risk. So let's talk about the risk here. And you think you might save risk, but actually I call this kind of the wrong risk. So the wrong risk is what the investment industry talks about all the time. It's about short-term temporary market declines. You're trying to avoid them. That's the wrong risk. So to me, is if I put some money in and it drops by 20 or 30% and then recovers, that's not risky, because it recovered. And we know from history that the market has recovered from all declines, and it'll probably continue to recover from all declines. So if you're a long-term thinker, that's actually not risk. And it may feel bad when your investments go down, but if you don't sell them and you just keep holding them and they recover, it wasn't actually risk. So this, again, is risk tolerance. It's a learned skill. We can teach you how to do that, and it's a highly beneficial skill. When you learn how to have a higher risk tolerance, then you can invest more effectively and get more growth, and it's huge, the difference that can make over 20 or 30 or 40 years. So that's the wrong risk. Now, the right risk is all about your long-term growth and your retirement goal. So it especially happens if you have a financial plan. Okay, but you're setting a goal where you need to make a good rate of return to achieve it. Now, I've had a few talks where I've compared different kinds of allocation. So whether you're 100% equities, or like a lot of the investment industry is, 60% equities, 40% bonds, that kind of thing. And what I can tell you, because I'm the guy that actually has done more than 1,000 financial plans, if you're working like a balanced fund, like you'll get from most bank advisors or even most regular advisors, you basically cannot retire comfortably, period. Full stop, give it up. You're going to retire pretty tight. So the only way to retire comfortably, really, for most people, is you need a good rate of return, like an equity rate of return. Let's say 8%, 8% a year or more as a long-term average return. So the right risk is, let's say, based on my retirement goal, to retire the way that I want in 20 or 30 years, I need to make 8% a year as an average return. Okay, so now real risk is in investment. If I choose an investment, the question is, how confident am I that I'm going to get 8% or more as a long-term average with that investment? Okay, and see, the reason this is important for the investment industry worried about short-term temporary declines, they think the more bonds or you put in or cash, or the more conservative your investment, the lower the risk. Okay, that's the wrong risk. The right risk is you're focused on the long term, and the more bonds you have, the less chance you have of getting you the return you need for the life that you want. So therefore, we tend to be, in most cases, if you can tolerate, you can learn to tolerate, have a higher amount of equities. And so that's what growth focused investors do. And now we're looking at, how do we make more money? And if you're thinking that way, the lump sum makes sense for you. For growth focused investors, the lump sum is probably the best choice. And its bottom line is, you're trying to invest for growth, and the sooner you get money in the market, the sooner it's going to rise. And basically, as the studies show, putting a lump sum in, it gives you the highest likelihood of getting a higher rate of return. It's probably 75%, like 2/3 or 3/4, depending on how you compare the dollars cost average, what strategy you're comparing to. But basically, it's much more likely that you're going to make more money when you put in a lump sum. So that makes sense. Now, this especially makes sense is if you get regular lump sums. Okay, so let's say that you get an annual bonus of 20,000, or what, you get a bonus every year. Well, stick it in all at once, because what's going to happen is, most of the time it's going to work out right. Occasionally it's not, but if you do a bunch of them, it's usually going to work out. So now, for a financial plan, it actually, again, people that have a financial plan tend to prefer lump sums as well, and it usually works out for them. I'll give you an example. So these are examples from some of my other talks, but let's say you're a couple that make 100,000 together. Okay, let's say 50,000 each. So this is a fairly modest plan, and you're 35 years old. You want to retire at 60, and you want to retire on 80,000 a year. So you make 100,000 a year before tax. Now you want to retire on 80,000 a year. Basically, that is, the house is paid off, but you want to do a bit more traveling and a bit more entertainment and have a bit more fun. So that's just that's a reasonable number. So to do that, I'm assuming maximum from all the government pensions and everything, and assuming you're making 8% per year, so a 100% equity portfolio, you need about 1.6 million 30 years from now. Okay, if you're investing in a balanced fund, like a lot of advisors would tell you, you need double that amount. But with equity and clients, equity investors, 1.6 million you need. Now, to get there, you need to invest 1128 a month, so 13,500 a year for 30 years, and make 8% a year on it. So what you're actually investing is 406, so just over 400,000 over a period of 30 years. Now, you can also achieve it by investing 158,000, so 160,000 now does what 400,000 does spread over 30 years. So the lump sum, if it's a significant lump sum early in your financial plan, is huge. So it's $250,000 less you need to invest for the same retirement. It's 60% less money that you need to invest. So it's huge how much that can the difference that can make over time. So when you have a financial plan, it changes your thinking. Okay, so now you're focused on achieving your goal. You're not worried about, oh, is the market? What's going to happen with the market this week or next month? Is it going to go up or down? Who cares? Because you know what? Long term, we know it's going to go up, and I have a goal to achieve. And let's put my money in. I'm trying to get to that goal. So when you're thinking that way, your lump sum is going to be your best choice. It's the highest chance to achieve the life goals that you want. All right, and also having a financial plan just keeps you focused on your goals, on your life, on the long-term growth. So that's the difference when you have a financial plan. You just think differently. You start thinking long-term. You think about your long-term goal. You're not worried about the short-term stuff, and basically that you end up making most of the decisions you make then tend to be very effective decisions, as opposed to if you're just panicking about, is the market going to go up this week or next month or this year, and all you're worried about is that, your gut is going to mess you up, and you're probably going to make a wrong decision most of the time. So the financial plan just first of all, it tells you what you need to do. You choose your own goal, and we do this. We call it interactive financial planning. We do that with our clients. We help you decide figure out what's the lifestyle that you want to have when you retire. What do you have to do to get there? How do you optimize everything? And we can figure out what's reasonable, like how much are you investing today that you could have, like how much are you taking out of your lifestyle today in order to have how much of a lifestyle later on. Helps you, an interactive financial plan lets you go through many different scenarios all in one sitting and figure out, okay, let's figure out what actually makes sense for me. Okay, so a financial plan makes a big difference for you. So my advice in all of this, so for growth focused investors, like most of our clients, lump sum wins. The best time to invest is whenever you have the money. So if you get a bonus, put it in now is basically whenever you have the money. And so usually the only way to use dollar cost averaging, like there is a bit of plus to it, it's just from your regular cash flow. So like just from your regular cash flow, you may have $1,000 or $2,000 a month that you're investing for your retirement. Well, that's perfect to use for dollar cost averaging, because you just put it in basically as you get it, have it go in after each paycheck, or if it's Smith Manoeuvre after each mortgage payment, and you're just automatically investing that way. But generally, whenever you have the money is the smartest time to invest. So the other strategy that you can do is it's actually strange, because a lot of people are thinking they're reducing risk by spreading out lump sums, but you can convert a monthly amount or a regular amount into a lump sum. And the way you do that is you kind of borrow the money sooner. For example, let's say that you've got $1,000 a month that you're going to invest. So one option you could do is just use your credit line, take $12,000 from it today, invest it in one shot, and now you use your $1,000 a month to pay that credit line off over 12 months. So now you've invested the money ahead of time. Now there is a slightly bit of an offset, because now you're paying some credit line interest. So, but this is a way to convert a monthly amount or a dollar cost averaging spread out investment into a lump sum. So if you're a growth focused investor or a person, working towards a financial plan focused on your future, converting a regular amount to a lump sum can actually be worth it. That especially makes sense when the market is down. Like, for example, today the market's down about 20-25% from the beginning of the year. So we consider any decline of 20% to be a buying opportunity. So it's a good time to say, well, I'm putting some money in regularly. Why don't I just stick in a whole year's amount or something like that? Let's try to convert the regular amounts I would be putting in anyway into a lump sum today. It's the opposite of thinking, should I do my lump sum over time? It's of thinking, should I do my over time investment as a lump sum? So it's a good way to think, and it's something that may make sense to you if you're a growth focused person, and if you're someone focused on your long-term financial plan. So All right. So again, my name is Ed Rempel. My blog is unconventionalwisdom.ca or edrempel.com. It's the #1 financial blog in Canada for a full service financial planner. And I've got tons of experience together with my team in financial planning, and we can help you achieve your life goals. So now, if you like this video, then you can like and share it either both on YouTube or on my blog, and by subscribing to it. All that happens is I try to do a video like this every Thursday, even if I'm on vacation. And by subscribing to it, we do zero marketing. All we do is then you get my new videos or articles every Thursday sent directly to your email. Thanks a lot for listening, and we'll see you next week.